Okay, so in this lecture, we are going to talk about, about what is Macaulay duration and modified duration. So I checked with AI. So here is what they have mentioned. Macaulay duration and modified duration are closely related measures of bonds' interest sensitivity, but they differ in what they represent and how they are used. So this is what is written. So both are basically, related to the bonds sensitivity to the interest rates, because we know that if the interest rates go up, the bond prices fall, and vice versa. If the interest rates fall, then the bond prices go up. Uh, so there is an inverse relationship between the bond prices and the interest rate. Now, since we are doing mutual funds, debt mutual funds, so these debt mutual funds, they invest into bonds, depending upon what kind of bonds they are investing. So if you look at in our this money control site, debt instruments, so there are various kinds of debt instruments which are available, like low duration fund, long duration fund, short duration fund, medium duration fund, medium to long duration fund. Then we have dynamic bond fund, gilt funds. So gilt funds with 10-year constant duration, corporate bond funds, credit risk funds, floater funds. So there are various varieties of debt funds which are available. Now they invest in bonds. So let's talk about some of the what does it mean? So these mutual funds select bonds oblique debt instruments for investment, such as that the average remaining period for portfolio is between 6 to 12 months. So which is called the Macaulay duration. Shorter the duration funds may provide lower returns but are less risky to interest rate changes. Now, if you select a low duration fund, they are least risky, okay, because they are not very sensitive to the interest rates. Because if the interest rates go up and down, these bonds will not move so much. Okay, as I told you, there is an inverse relationship between the bond prices and interest rates. So these funds will be least affected, and their Macaulay duration is between 6 to 12 months. What does Macaulay duration means? Macaulay duration means that how long it takes to get your money back. That means suppose you have taken a bond for 100 rupees, it carries a coupon rate of say 25%. So that means every year you're going to get 25 rupees. So in the fourth year, you're going to get, suppose it's a 4-year bond. So you're going to get in the fourth year, you're going to get 125. So 25 in the first year, 25 in the second year, 25 in the third year, and 125 in the fourth year. So that means in fourth year, you are paid the full amount. Okay. So even less than 4 years. Suppose it was a 5-year bond. So in 4 years, you are getting, almost like 100 rupees coupon. So the Macaulay duration should be around 4. But we take the present value of whatever money you're getting. So it will be 4 point some months. Okay. So the Macaulay duration is the time frame in which you recover your money. So that is what is written in the explanation here. So I'll just open this again for you to understand. So Macaulay duration definition: the weighted average time in years it takes to receive the bond's cash flows, coupons, and principal. Okay, so it is expressed in time. It shows the average maturity of the bond cash flows, and the formula for calculating is given below. So which talks about the present value of the cash flows which are generated by the bond coupon rate. Okay, so then you calculate how much time it takes to get your money back. So that is called Macaulay duration. Higher the Macaulay duration, more riskier will be the bond because it will move up and down as the interest rate changes in the economy. Okay, so a longer duration mutual funds will be more riskier. So if you look at for example, all these mutual funds, so we have short duration, low duration, and longer duration. Now, longer duration funds are more riskier compared to the low duration funds, because if the interest rate changes, these funds can go up and down, and you can even lose your money. So let's look at like for example, long duration funds and see what are those funds. So these are the various funds. So look at kind of a 1 year kind of a period in which those funds have given a return. So rather look at so if we can just look at for example, a 10-year bond or a 1-year bond. Okay, and if I sort them according to this thing, so these bonds have given approximately These are percentage of return which the bond has given, 2%, 2.4. It's very less. Okay. So which signifies that the interest rates have actually gone up during this period. So the bond may be having a good coupon rate, but it has, gone down because of the interest rate changes. So if you just download this data and see what happens. So these were, the longer duration bonds. Okay, fine. And I told you they're riskier. And so why are you not getting the file? I'm just going to download again. Okay, so these are the longer duration bonds. So what I'm doing is I'm just, there are very few funds in this category. So what I'm doing is I'm deleting the first, row, and then I'm deleting the direct plans row because we don't need it. And similarly, the category type because we know it's a long duration fund. And then we see, how much return these funds have generated. Okay, so we do Control T and change the color. So if you look at, for example, a 2 years return. So these funds have given, maximum return has been 9%. Okay. And 1 year return has been, quite muted because if you look at these funds and see where they have invested the money, let's look at, a Mirai long duration fund or maybe a Franklin India duration fund. So where they have invested. So we'll find the full details about this fund. So my internet is a bit slow today. Let me just check. Okay. So this is Franklin India low duration fund. The size of this fund is only 38 crores. Okay. And so this is, the fund has 96% investment in debt, of which 96.29 in government securities, suitable for investors who want to invest money for longer duration but prefer less risky assets compared to equity funds. So they are, less risky compared to the equity funds, definitely because you're putting your money in bond funds. Okay. But these funds are more sensitive to the interest rate changes. So if you look at, where they're putting the money, GOI, that is government securities, almost 96% of the money has been put into these funds. So, and non-convertible debentures and bonds of the of the companies, where it's about 3.6%. So let's move out from this. So this is Macaulay duration. Okay. Then we have modified duration. So there is yet another, kind of area where we should look what is modified duration. So this is another metrics. So a direct measure of bond price sensitivity, a direct measure of bonds price sensitivity to changes in yield, interest rate. So that means this tells you how much, the bond, if the interest rate goes up by 1%, how much will be the price fall in the bond. Or similarly, if there is the interest rate falls, the bond prices will go up. So how much does it change? Okay, in terms of percentage. So so if you look at the modified duration and Macaulay duration here, measures in years tells you the weighted average time until the cash flows are received. So Macaulay duration tells you how long you're going to receive your money, whatever money you have invested in a bond, how much time it takes to recover the amount. Okay. And suppose it takes 3 years, then the Macaulay duration is 3 years. If it takes 5 years, that means the Macaulay duration is, 5. So the longer the Macaulay duration, the bond will become riskier. Okay, it will be more sensitive to the interest rate changes. Whereas modified duration tells you the percentage. Now you want to know that if suppose there is a 1% change in the interest rate, whether the interest rate goes up or goes down, how much the bond price will change. Okay. So if you have a view that, in the next 1 year, the interest rates are going to fall. So you expect the interest rate to fall by 1%. So you would like to know how much, money you are going to generate as a capital gain in terms of bond price going up. So that is what the modified duration tells you. So it is a modified duration, which is very, very important, metrics to look at, because it tells you, how much would be the change in the bond value. Suppose you take a bond and instead of the interest rates going up, it goes down. Then you may going to suffer a capital gain, okay, capital loss, which means that the 1% increase in a bond in the interest rates may actually, what will happen to the bond prices? The bond prices are going to fall and you're going to lose money. So let's look at, example here. Suppose, there is a bond whose face value is 100 and the coupon rate is 10% annually. Okay, so that means you're going to receive 10 rupees every year, and maturity is 3 years. So that means you're going to get 10% return YTM. If you hold the bond till maturity, you're going to get 10% return till you hold the bond. Okay, and then this is the cash flows which you're going to get. Year 1, 10 rupees. Year 2, 10 rupees. In the year 3, you're going to get the principal also along with the coupon. So you're going to get 110. So present value of these cash flows will give you a figure. In 3 years time, you're going to get your 100 rupees back. Okay, fine. So 9 rupees, in the first year and 8 rupee 26 paisa in the second year, because what we are doing is we are calculating the present value of the cash flows. So 10 rupees received after 1 year will be 10 divided by 1. So we are going to discount that 10 rupees and calculate the present value. So it will be 9.09. The second year coupon money which you are going to receive, if you receive it today, its present value is 8.26. In the third year, you're going to get 110. So if you divide by 10%, okay, raised to power 3, that means you're going to get the present value is 82.64. So the bond price comes to, what you're going to get is 100 rupees in 3 years. So here, the Macaulay duration is 3 years. Let's see. So Macaulay duration, if you just calculate, so it is, in the year 1, you're getting this. In the year 2, you're getting, this plus the second year, which is 16 point. In the year 3, so you multiply it by, you give weightage of 1, 2, and 3, okay, to all the money which you're getting. And then what you do is, this is the formula basically. So you add all this up, which comes to 273.53. So, what I'm explaining here is that in the year 1, you're going to get 9 rupees. So you give a weight of 1. In the second year, you're going to receive 8 rupee 26 paisa. You give a weight of 2. And in the third year, you're going to get 82.64, which is a principal also, plus the coupon. So you multiply it by 3. So it comes to 273 and divided by 100, which is the face value of the bond. So look at the formula. So it gives you a figure of 2.74. So average time you get your money back is 2.74. Okay, so this is how we calculate the Macaulay duration. For every bond where you invest, if you calculate the Macaulay duration, it will be calculated the same similar way. And if the Macaulay duration is more, so that means the bond is more riskier, because it may give you a good amount of return if the interest rate falls, but if the interest rate goes up, then you're going to lose money. Okay, fine. So this is the riskiness of the bonds. Then what is a modified duration? Basically, the formula is, here we take the Macaulay's duration, which is 2.74, and divided by 1.1. Okay, so which is, we get 2.49. Okay, so annual compounding, so which is at 0.10. Fine. So here the modified duration is 2.49. So the formula is Macaulay modified duration is equal to the Macaulay duration itself divided by 1 plus y, where y is the rate of interest. Okay, so where we divide this by this, so we get 2.49. So the bond price sensitivity is about 2.49 for every 1% change in interest rate. So if there is a 1% change in interest rate, the bond price will move 2.49% if the modified duration is 2.49. So as here we come to know how much you're going to lose or how much you're going to gain. Okay. So, so let's, summarize this. Final takeaway, Macaulay duration 2.74 tells us on an average how long it takes to get the money back. So I read it again. Macaulay's duration 2.74 years tells us on an average how long it takes to get back the bonds money. Okay, so this is how long you're going to take to get back the money. Whereas the modified duration tells us the price will fall minus, 2.49% if the interest rate rise by 1%, and rise by 2.49% if the interest rate falls by 1%. So if you are expecting the price to fall, okay, if you're expecting the interest rate in India is going to fall, then you invest in bonds and always choose a longer duration bonds, because here you are going to get a very good amount of return. But if you think the interest rates are going to, you are uncertain about the interest rates, so always choose a low duration fund. So now if you go back here and look at the chart here, you know, so there are various funds, low duration. So only when you're uncertain about the interest rates where they're heading, so you should always go for low duration. Short duration also will be slightly riskier than the low duration, because here the modified duration will be little higher than compared to the low duration. So if you're uncertain, but you think that the interest rates are going to fall eventually in next 1 or 2 years, so you can put your money in a short duration. So you're taking a risk. You're betting that the interest rates may change, but not so much. So you should invest in short duration funds. Similarly, in medium duration funds and long duration funds, you should choose only if you are very certain that the interest rates are going to fall. You will make only money if the interest rate falls and your bond value goes up. So you will get a capital return in this category. But if it goes other way, the interest rate instead of falling goes up, then these funds become very riskier.